Welcome, class, and let's jump right into this explainer. As your professor today, I'm going to walk you through a chronological masterclass on how macro-level Federal Reserve policies actually dictate the everyday borrowing costs we all face. We're talking everything from your future mortgage rate to the corporate finance strategies you'll be building in your careers. All right, let's dive right into today's syllabus. We're going to map out 5 distinct economic eras: the Nixon Shock, the Volcker Shock, the Great Moderation, the 2008 crisis and ZLB, and finally, the pandemic and SOFR. We're tracing a massive historical roller coaster today. We'll start in a relatively stable, gold-backed world in 1971 and ride that track all the way to the unpredictable whiplash of our post-pandemic economy. Each of these stops represents a tectonic shift in how money actually works, and understanding them is absolutely crucial for any student of business. So, let's kick things off with era number 1, the Nixon Shock. Up until August 15, 1971, the global financial system was essentially tethered to physical gold under the Bretton Woods System. But on that pivotal day, the system finally cracked under the heavy weight of deficits. By breaking that $35 per ounce gold peg, the government completely unanchored the financial system. We instantly entered a brand new era of fiat currencies, meaning money derived its value simply from government decree, rather than being backed by a physical block of gold sitting in a vault.
Now, without that physical anchor tying things down, central banks were suddenly totally free to just print money. And, well, print they did. This unleashed massive monetary and credit volatility, sharply devaluing the US dollar and kicking off a devastating decade known as the Great Inflation. The purchasing power of the everyday consumer was basically eroding right before their eyes, which perfectly sets the stage for our next major crisis.
Which brings us to Era 2, the Volcker Shock.
By 1979, the U.S. economy was literally choking on stagflation. We had a toxic mix of high unemployment, sluggish growth, and inflation running at an alarming 14.6%. To fight this, the new Fed chairman, Paul Volcker, decided to target the money supply directly instead of just tinkering with tiny incremental rate hikes. The result? By March 1980, the Fed funds rate hit an absolute peak of 20%. For you as business students, just think about that baseline cost of capital. It was a complete shock to the system.
Imagine trying to buy your first house or trying to secure a loan to start your business in that kind of environment. The prime rate skyrocketed to 21.5%, and 30-year fixed mortgages topped 18%. It was a brutal, incredibly bitter medicine. It completely killed the homeownership dream for a lot of people, caused 2 severe recessions, and pushed unemployment to 11%. But here is the critical takeaway. It worked. It successfully broke the back of inflation, crushing it all the way down to a manageable 2.5% by July of 1983.
And that painful medicine paved the way for our third era, the Great Moderation.
Under Volcker's successor, Alan Greenspan, things calmed down. From 1987 to 2006, federal funds rates comfortably averaged between 3 and 8%. Following the terrifying Black Monday stock market crash in 1987, Greenspan famously declared the Fed's readiness to essentially act as a massive safety net. This became known as the Greenspan put. But while it created tons of short-term confidence, critics rightly argued that this exact complacency, this perceived safety net of cheap credit, fueled the dot-com bubble and ultimately the catastrophic housing bubble.
And that brings us straight into Chapter 4, the 2008 crisis and the zero lower bound. When that massive housing bubble burst, global credit markets just completely froze. The Fed had to make dramatic emergency cuts, pushing the target range all the way down to 0 to 0.25%. We call this ZIRP, or Zero Interest Rate Policy. Think of ZIRP like the Fed dropping the economic floor straight down into the basement. When traditional medicine stops working because your patient's interest rate is already at 0, a theoretical boundary we call the zero lower bound, you have to invent a radically different treatment just to keep the economy breathing. And that new radical treatment was quantitative easing, or QE. If ZIRP is like opening the financial pipes as wide as they'll go by keeping rates at 0, QE is the massive financial adrenaline shot. The central bank basically uses a huge pump to force liquid cash directly into the banking system's bloodstream by buying up staggering amounts of government bonds and other securities. This was a massive structural shift, and it completely reshaped everyday finances for 7 long years. This lower-for-longer era was incredibly punishing for everyday savers. You're earning essentially nothing on the cash in your bank account, which forced everyday people into much riskier assets just to find some kind of yield. But on the flip side, it simultaneously made borrowing historically unbelievably cheap for governments and massive corporations. Which naturally leads us to our 5th and final era, the pandemic and the shift to SOFR.
When pandemic lockdowns hit in March 2020, we saw a near-exact replay of the 2008 zero-rate playbook. Emergency cuts right back to zero, but this time throw in massive supply chain disruptions and historic fiscal stimulus, and it ignited a ferocious spike in inflation. So the Fed had to engage in the most aggressive rate hikes in 40 years to fight it. But while everyone was watching those rate hikes, another massive shift was happening quietly behind the scenes. The entire global benchmark for private contracts shifted away from LIBOR, which was an unsecured, estimate-based, and highly manipulated metric, over to SOFR. And SOFR is fundamentally different because it's a risk-free rate based on over $1 trillion in actual, verifiable daily transactions.
As future business leaders, take a good, hard look at this historical timeline. It perfectly captures the extreme whiplash of our monetary history. We've swung from a 5% baseline up to a staggering 20% peak during the Volcker shock, all the way down to the absolute basement at 0.25% during the 2008 crisis. And now we're back up, hovering above 5% in our modern SOFR era.
So I want to leave you with this provocative thought as we wrap up. In this new normal of constant vigilance, the era of predictable, slowly moving interest rates is officially over. The benchmarks we rely on are now tactical instruments, kept in a state of permanent readiness. So how are you going to navigate your corporate finance decisions, and how will you adapt your strategies when the next inevitable crisis hits? Class dismissed for today, but keep that question at the very front of your minds.